Who was Jack Bogle, and why should you listen to him? Jack Bogle wasn't a Wall Street celebrity. He wasn't flashy, he didn't chase trends, and he definitely didn't worship market gurus. He did something much more powerful. He changed investing forever. Bogle founded Vanguard, created the very first index fund, and declared open war on the one thing that silently eats your wealth: fees. His philosophy was brutally simple. Keep costs low, buy the whole market, stop trying to outsmart everyone and think in decades, not days. No predictions, no fancy strategies, no drama. Just math, patience, and discipline. And here's the crazy part. The strategy he championed has beaten over 90% of professional money managers. Not sometimes, consistently. If you want to build real wealth without needing genius-level intelligence or insider access, Bogle is the one person you can't afford to ignore. And hey, if you want more videos that cut through noise the same way Bogle cut through Wall Street hype, hit subscribe and drop a like. It costs you nothing, which Jack would definitely approve of. Jack Bogle built his entire life's work on one brutally simple idea. The stock market will give you exactly what the stock market is worth. Not more, not less. And once you understand that, you stop wasting time chasing magic tricks and start focusing on capturing what the market already offers. Because here's the uncomfortable truth Bogle kept repeating for decades. Almost no one, not even the professionals, can consistently beat the market. They try, they predict, they shuffle portfolios, they brag when it works and hide when it doesn't. But in the long run, the math crushes them. Costs, taxes, timing errors, ego, everything eats away at returns faster than any strategy can compensate. Bogle flipped that mindset completely. He argued that you don't need to beat the market to get rich. You just need to own it. If the market goes up 8% a year on average, and you keep almost all of those 8%, your wealth compounds automatically. But if you only keep 5% or 6% because you're paying for trading, management, funds that churn, and mistakes you're encouraged to make, the difference becomes enormous over decades. This is why Bogle obsessed over one variable: cost. Because the less you pay, the more market return you actually keep. It sounds obvious, but most investors never stop to measure it. The financial industry certainly doesn't want you thinking about it. Indexing solves this in the cleanest way imaginable. You buy the entire market, thousands of companies all in one fund, and you pay almost nothing for the privilege. No one picking stocks, no one timing the economy, no clever maneuvers. Just pure exposure to the long-term growth of businesses. And because you're not trying to outsmart the market, you're not making constant decisions. You're not moving money every time the news scares you. You're not rotating sectors. You're not selling winners too early or holding losers too long. You simply capture what the market delivers. Bogle often described index investing as owning the haystack. Instead of searching for the one miracle needle that outperforms everything else, you buy the whole thing, ensuring that you own every needle that will matter in the future. This is why indexing quietly beats the overwhelming majority of active investors. It doesn't rely on predictions. It relies on math, on cost efficiency, and on the unstoppable upward bias of human economic progress. The market grows because companies grow, productivity grows, populations grow, innovation compounds. Owning that entire engine is enough. Now, when people hear this philosophy, they often think it's only useful for large investors or people with millions. But Bogle's message was the opposite. This approach is especially powerful for people with modest savings, because when you eliminate the drag of high fees and emotional mistakes, the compounding becomes shockingly efficient. Suddenly, a portfolio of 100K, 200K, or 300K doesn't feel small. It feels like a seed with a predictable growth rate. Over decades, keeping almost all of the market's return turns not enough into more than enough. That's why Bogle's philosophy is at the core of retiring early with a relatively small amount of capital. You don't need heroic returns. You don't need to gamble. You don't need to guess the next Apple or Tesla. You just need steady exposure to broad economic growth at the lowest cost possible for the longest time possible. The market already does the heavy lifting. Your job is simply to avoid getting in its way. Bogle used to say, "Don't look for the needle, buy the haystack." What he meant is this: the market will give you everything you need if you stop fighting it. To most people, $300,000 doesn't sound like a life-changing number. It's not flashy. It's not the kind of figure you see in "I retired at 32" headlines. And it's definitely not what Wall Street would call wealth. But Bogle never cared about definitions of wealth built on status. He cared about mathematics, specifically the quiet, compounding math that turns a modest sum into a sustainable engine of income. And when you run the numbers from his philosophy, something interesting happens. 300K stops looking small and starts looking sufficient. First, consider the long-term real return of the stock market. Not the nominal return inflated by temporary booms or by media hype, but the real return, what you actually gain after inflation eats its share. Bogle's decades of research consistently pointed to a real return around 6–7% annually for a broad market index. That range is conservative, historically grounded, and resilient across different economic eras. So let's stay near the middle and think in terms of 7%. That single percentage changes the whole conversation, because 7% on $300,000 isn't vague. It's arithmetic, roughly $21,000 a year. And that's without touching the principal in any meaningful way. People often underestimate what a 7% real return means when applied to a stable base of capital. They imagine market crashes, volatility, bad years, recessions, and they're right to worry. But Bogle's framework assumes all of that. Index funds survive bad years because they don't rely on timing or prediction. They simply sit, accumulate dividends, track corporate earnings, and ride out storms the same way the economy does. A bad year doesn't break the strategy. It's already priced into the long-term return. Now, Bogle was famously conservative when it came to withdrawals. While some financial planners encourage 4% withdrawals, Bogle viewed that as potentially aggressive, especially in unpredictable markets. He leaned closer to 2–3% annually for anyone seeking resilience and peace of mind. Apply that thinking to 300K. A 2% withdrawal is $6,000 a year. 3% is $9,000. That might sound small, but here's where the structure of Bogle's philosophy clicks into place. You're not meant to replace your entire life with portfolio income. You're meant to support a lean, optimized lifestyle, especially one with low fixed costs. If your expenses are modest, if your life is simplified, and if you design your lifestyle around freedom instead of consumption, the portfolio doesn't need to carry everything. It just needs to provide stable, predictable reinforcement. And that's the heart of this rule. 300K is enough to achieve independence, not extravagance. It buys you time, options, and flexibility. It lets you choose part-time work, freelance projects, or slower-paced living without financial pressure. It turns "I must work" into "I can work if I want." That psychological shift is the core of freedom. Many people imagine financial independence as a cliff you leap off when you hit $1 million or $2 million. Bogle reframed it as a slope, a gradual transition supported by compounding returns and thoughtful withdrawals. With a 7% real return and a disciplined withdrawal rate, $300K doesn't vanish. It regenerates, it grows, it supports you year after year because the system is designed to work with market behavior rather than fight against it, and none of this requires luck, timing, genius, or insider knowledge. It's not magic. It's not a hack. It's not even particularly ambitious. It's just mathematics applied consistently, quietly, and without emotional sabotage. The reason few people reach this point is not that the math fails, it's that they do. They get impatient, they chase returns, they panic in downturns, they jump in and out of funds. They behave exactly the opposite of what Bogle taught. But if you stay the course, Bogle's favorite phrase, then $300,000 doesn't represent an endpoint. It represents a threshold, a pivot from dependence to autonomy, a point where compounding becomes a partner rather than a concept. And once you cross it, the numbers start working for you instead of against you. Bogle's real message wasn't, "You need a fortune to retire." It was, "You need discipline to let your capital become a fortune." Jack Bogle had an almost obsessive mission to eliminate all unnecessary intermediaries between the investor and the real growth of the market. For him, financial independence didn't come from complicated strategies, but from structures so simple and so efficient that they practically ran themselves. And if he had to choose the central tool to transform $300,000 into freedom, there would be no doubt. An ultra-cheap index fund, whether tracking the S&P 500 or the U.S. total market, nothing more, nothing less. Why is this simplicity so powerful? Because a cheap index fund doesn't try to outperform the market. It simply mirrors it. It takes thousands of companies, or the 500 largest in the country, and turns them into an automatic growth machine, driven by the real economy. When the companies grow, the fund grows. When they pay dividends, your stake increases. When some companies fail, others replace them without you lifting a finger. The structure readjusts itself. It requires no talent, constant analysis, or emotional decisions. It's a system designed to survive decades, not moments. Bogle understood that the investor's greatest enemy isn't volatility, recessions, or even occasional mistakes. It's cost. Every dollar paid in fees is a dollar that isn't compounding. That's why he insisted on funds with expenses of 0.03% or 0.05%, figures so small they seem irrelevant on a daily basis, but which, accumulated over 30 years, are the difference between stable independence and an eroded portfolio. Ultra-cheap index funds are his answer to this problem. Vehicles that allow you to capture almost all of the market's performance while paying practically nothing. And then there's the second principle, no trading. You don't buy today to sell tomorrow. You don't jump from one sector to another. You don't cash out because the headlines announce chaos. The only way for this mechanism to work is to remain invested at all times. The market's biggest returns are usually concentrated in just a few days, scattered over years. Missing those days, because you exited the market out of fear or tried to anticipate movements, drastically reduces your returns. Bogle said, Don't look for the perfect time to buy or sell. The perfect time to invest is when you have the cash on hand, and the perfect time to sell is never. A bit of an exaggeration, yes, but the message was clear. Permanence trumps precision. The brilliance of this system is that it transforms $300,000 into an organism that expands without human intervention. The combination of dividend reinvestment, business growth, and minimal costs creates a capital curve that slopes ever upward over time. There's no constant approval required, no secret levers to pull, no strategies to update. It works because the economy grows and you silently participate in that growth. The average investor often imagines that financial independence requires daily monitoring, company analysis, chart interpretation, and constant study of economic news. But Bogle demonstrated that the opposite approach, disciplined passivity, is more profitable. Ultra-cheap index funds make the market your partner. You provide the capital, it provides the movement. You provide the patience, it provides the growth. This mechanism not only protects your money, it also protects your mind. It frees you from the anxiety of, am I doing the right thing? And the risk of making impulsive decisions. Instead of reacting to market noise, you align yourself with its overall direction, upward, for the long term. And when your goal is to live off your portfolio, not guess its next move, that alignment is everything. In essence, the Bogle system is precisely that, a system, a set of simple, cold mathematical rules that allow a relatively small amount of capital to become a generator of independence. Not because it's magic, but because it's resilient, automatic, and designed to avoid the human errors that destroy returns. Ultra-cheap index funds don't promise excitement or glamour. They promise something better, results. If Bogle's non-magical magic had to be summarized in a single idea, it would be this: let the math do its work. There are no shortcuts or psychological tricks, just numbers applied patiently. When we talk about an average real return of the 7% per year, we're not talking about promises or adrenaline rushes. We're talking about a reasonable historical average adjusted for inflation and acknowledging that there will be bad years and good years. Now, let me explain step by step why that 7% turns $300K into a sustainable source of cash flow if you avoid two things: exorbitant fees and panic selling. What does 7% real mean? It means that after adjusting for inflation, the economy, and therefore the broader market, has tended to deliver something like 6 to 7% annually over long periods. It's not a guaranteed number, but it's a conservative assumption based on decades of data. If you accept that assumption, you already have the most important lever: real compound growth. Gross return versus net return. Imagine the market yields 7% and you pay 0.05% in costs, a cheap index fund. Your net return would be approximately 6.95%. Now, imagine you pay 1% in fees. Your net return drops to 6%. That difference, sustained over time, translates into hundreds of thousands of dollars lost to fees. That's why Bogle was obsessed with cost. Removing friction means keeping more than the original 7%. Simple calculation: 7% on $300,000. 7% of $300,000, $21,000 per year. That number is the starting point. Without touching the principal, if the market averages 7% real return, your capital generates 21 annually in real purchasing power. Obviously, in practice, there will be years when you produce less and other years much more, but the average is what matters. Prudent withdrawal, 2 to 3%. Bogle favored conservatism. Instead of the classic 4% withdrawal, he advocated more prudent withdrawals, 2 to 3%, to protect against adverse return sequences. 2% of 300K to have 6,000 a year, 3% of 300K to 9,000 a year. These flows alone aren't luxurious, but they should be seen as part of a structure. Optimized spending, other smaller sources of income, and the ability to adjust your lifestyle. Why you don't consume your principal. If the market yields 7% and you withdraw 3%, your principal doesn't automatically plummet. Net of withdrawals, you're left with approximately plus 4% real growth. Mathematically, that means your capital continues to grow even if you withdraw an annual amount. Example, if capital grows net by 4% annually, the growth factor over 30 years is 1.04, 3.204. That is 300K, 973K after 30 years, provided you made withdrawals during that period. In other words, your portfolio can sustain moderate withdrawals and continue to grow in the long term. The power of compound interest applied to moderate withdrawals. If you don't withdraw, or withdraw very little, and let the 7% compound interest work, the growth is even more spectacular. 1.07, 30, 7.61, so 300K, 2.28 miles in real power over 30 years. But Bogle's practical point wasn't to exponentially increase for the sake of it. It was to show that with modest and sustained returns plus disciplined withdrawals, financial independence is achievable without exotic numbers. The return sequence trap. The math works, but with one critical condition. Don't abandon the plan during downturns. If you suffer severe losses in the early years and also withdraw a lot, you can quickly erode your principal. That's why Bogle's rule includes staying invested and withdrawing prudently. With a conservative withdrawal plan, the impact of a downturn is reduced because a large portion of the capital remains invested and captures the market's historical recovery, cost sensitivity, and behavior. Small differences matter. Lowering expenses from 1% to 0.05% increases your net return and multiplies your capital in the long run. The same applies to behavior. Panic selling turns an average of 7% into a much lower net return for you. Mathematically, these two variables, cost and behavior, are the only ones you can control. The market, 7%, and time, years, do the rest. Final practical example. Let's assume 7% average real return, almost zero commissions, 3% annual withdrawal. Over a 30-year horizon, the portfolio grows net by approximately 4% annually, multiplying the capital by about 3.24. You've withdrawn money every year, and yet the final capital is greater than the initial amount. That's what Bogle wanted you to understand. It's not magic. It's the sum of reasonable returns, minimal costs, and disciplined withdrawals. The numerical and philosophical conclusion, the 7% is just the lever. What turns $300,000 into financial independence is combining that plausible return with low fees and a prudent withdrawal policy, and then staying calm while time and math do their work. It's not glamour. It's common sense applied to numbers. Jack Bogle often repeated an idea as simple as it was uncomfortable. True wealth doesn't depend on what you earn, but on what you don't spend. This phrase encapsulates one of the most ignored truths in the financial world. Many people obsess over multiplying income, finding the next miracle investment, or chasing impossible returns. But almost no one wants to look at the less glamorous side, their own spending habits. And yet, if we're talking about living on $300,000 without ever working again, this is the point that determines everything. The reason is straightforward. With a moderate net worth, every dollar you don't spend is a dollar you don't need to earn. Reducing expenses not only lightens your budget, it also increases your financial survival rate. because it reduces the pressure on your investments. When expenses are low, returns have room to breathe. When expenses are high, not even $1 million seems enough. That's why Bogle insisted that before looking at the market, you have to look in the mirror. At this point, it's explained that living on $300,000 isn't a fantasy, but it does require a balanced, mindful lifestyle far removed from impulsive spending. It doesn't mean living poorly, but rather living well with less. And to achieve this, you need to understand how to control each of the spending categories that drain your wealth the most, because not all of them have the same impact. 3 areas change everything: housing, transportation, and invisible costs such as subscriptions, small recurring indulgences, and automatic expenses that accumulate without you even noticing. First, housing. This is the most crucial expense. Bogle didn't advocate for luxury, but rather for functionality. A sufficient place, not a social symbol. Maintaining a low rent or a small mortgage reduces the monthly pressure and makes a $300,000 net worth truly sustainable. When you choose a home that's below your budget, you not only save money, you also gain freedom. You free up mental and financial capital, and that allows compound interest to work uninterrupted. The second critical expense is transportation. Here, most people lose money without realizing it. Buying expensive cars, changing vehicles too frequently, or financing models you don't need are among the biggest enemies of wealth growth. Bogle advocated the opposite: simple, durable, and functional vehicles. An inexpensive car that does the job not only reduces your monthly expenses, but also avoids costly insurance, excessive maintenance, and unnecessary depreciation. The third category, the most silent, consists of invisible expenses: digital subscriptions, unplanned meals out, impulse purchases, bills you forgot to pay, and small decisions that add up to much more than you think. This type of spending has an additional danger. It gives the impression that nothing's wrong, because each amount is small. But Bogle reminded us that the sum of small mistakes can negate the effect of big successes. Reviewing these leaks, eliminating them, or reducing them has an immediate impact on your budget and directly improves your sustainable retirement rate. Furthermore, keeping expenses low has a profound psychological benefit. It frees you from the cycle of, "I need more money to maintain my lifestyle." It allows you to take a break from that endless race, and above all, it makes financial freedom achievable without absurd figures. With discipline, a modest fortune stretches. Without discipline, even double that amount won't be enough. This section explains that Bogle's plan isn't about living like an ascetic, but about living sensibly. It's not about deprivation, but about optimization. Because when your expenses decrease, the income needed to sustain you also decreases. That means less stress, greater resilience in the face of volatile markets, and a lighter life. Low spending isn't a sacrifice. It's the hidden tool that makes $300,000 a long-term financial lifeline. Because ultimately, independence isn't bought with high income, but with smart decisions and voluntary restraint. Jack Bogle often repeated an uncomfortable truth: the investor's greatest enemy is the investor himself. It's not recessions, bear markets, or interest rates. It's us, our emotions, our impatience, and our natural tendency to sabotage our own plans. And this is crucial because the method of living on $300,000 only works if you master something far more difficult than math: your behavior. Here's the explanation. This approach doesn't require financial genius, but rather avoiding basic mistakes. Because, according to Bogle, most people don't fail due to a lack of knowledge, but rather due to excessive impulses. And these impulses always repeat themselves. Entering and exiting the market out of fear, trying to predict the future, chasing trends that shine for a few months and then disappear, or panic selling just when the market offers the best opportunities. The real difficulty lies not in the system, but in maintaining composure when everything around you seems to be falling apart. The first point is not to enter and exit the market. Bogle explained that many investors destroy more value by trying to protect themselves than by going with the market's historical trend. The act of selling at a bad time and buying back later, but at a higher price, is a universal pattern. He analyzed it time and again. Nobody leaves the market at the peak. They always exit at the worst possible moment. And this behavior, repeated for years, eliminates any possibility of making a living from capital. If you sell every time you're afraid, you never allow compound interest to do its job. The second mistake is trying to predict the future. Bogle said that there is no Nobel Prize winner capable of consistently predicting the market, and that every attempt to anticipate market movements only generates frustration. Investors spend more time worrying about what might happen than acting according to sound principles, and paradoxically, predictions rarely matter. What really counts is staying invested when the good years arrive. Those who try to predict the future are always wrong at the critical moment. The third enemy is chasing trends. This is one of the favorite traps of impatient investors. When a stock or sector becomes fashionable, when everyone is talking about it, when it seems like this time it's different, that's when Bogle would raise his hand and say, "If you know about it now, you're already late." Financial fads usually have the same disguised argument. They rise quickly, attract thousands of people, generate euphoria, and then disappear as quickly as they arrived. Those who cling to them don't build wealth. They create emotional lotteries. The fourth point is not to panic during downturns. Bogle was especially insistent on this. He repeated that markets always fall, always correct, and always generate fear. But he also said that these downturns are the entry cost for obtaining long-term returns. People who sell at these times are paying twice. They lose value when they exit, and they miss out on recovery by not being in when the market rebounds. And history shows that those who remain steadfast after the downturns are the ones who end up financing their financial freedom with a relatively small amount of capital. Furthermore, this section includes anecdotes illustrating how discipline makes all the difference. Bogle recounted that during the 2000 crash, many investors fled the tech market en masse, but the few who maintained their positions or simply continued contributing small amounts without paying attention to the noise recovered everything and generated enormous profits years later. The same thing happened in 2008. While some liquidated everything out of fear, others remained calm and over time saw their wealth rebuild and grow even faster than before the crisis. He also spoke of the average investor who never had a high salary but did have ironclad discipline. This type of person, who ignores alarmist headlines and sticks to their plan without emotion, ends up accumulating more wealth than those who earn a lot but don't control their behavior. Bogle said that finance is not a contest of intelligence, but of character. In short, this section explains that achieving a living on $300,000 is not an act of luck, but of emotional stability. The method works if you don't make the same mistakes that destroy the wealth of millions of people every decade. Because ultimately, discipline doesn't just protect your money, it also protects your future. When Bogle spoke of financial independence with relatively little capital, he never spoke of mystery or speculation. He didn't believe in tricks, he believed in processes. And if someone today wanted to live on $300,000 following his philosophy, the plan would be surprisingly straightforward. Not perfect, not magical, but robust enough to survive decades of unpredictable markets. Here's how that capital becomes a simple, stable, and predictable machine, always in the hands of a disciplined investor. The first step is the core portfolio structure, between 80 and 100% in a total market index fund, a fund that buys virtually the entire U.S. market. This choice encapsulates Bogle's entire life, because for him, the more diversified and simpler the investment vehicle, the better it worked. A total market index fund doesn't try to guess which company will win, because it buys them all. It doesn't try to beat the market, because it is the market. And above all, it doesn't depend on your ability to choose the perfect moment. It's a system that grows with the economy as a whole, and that's always a safer bet than investing in individual companies. The reason this fund serves as the core of the plan is clear: it virtually eliminates human error. You don't have to rotate sectors, chase trends, or worry about corporate news. The fund structure itself takes care of integrating each new market winner and slowly weaning off the losers without you having to lift a finger. And that allows the $300,000 to begin following a natural path, growing with the country's productivity year after year without your emotions interfering. The second pillar of the plan is the 2 to 3% annual withdrawal, an extremely prudent figure that Bogle championed as a way to ensure the principal doesn't erode rapidly. This means that with $300,000, you would withdraw between $6,000 and $9,000 a year, a modest but sustainable amount, even during periods of volatility. Although it may seem like a small amount, the key here is the longevity of the system. You're not looking to maximize your withdrawals. You're looking for your wealth to outlive you. And for that, Bogle always preferred frugality to lifestyle inflation. The third point of the plan is an annual rebalancing, a simple step that prevents unnecessary imbalances. It's not about adjusting the portfolio every time something happens in the market, but rather dedicating a single moment each year to review whether the exposure has shifted drastically. If, for example, the market rises too much and your equity exposure exceeds the 100% allowed by your rules, you simply reset the percentages. This minimal action keeps risk under control without turning you into a constant trader. The next component is maintaining an emergency fund equivalent to 6 to 12 months of expenses separate from the main capital. This cushion protects the plan in the same way a parachute protects a jumper. You don't use it every day, but the day you need it, it saves your financial life. This fund prevents you from having to sell stocks at a bad time, which is exactly what destroys the returns of those forced to liquidate positions during market downturns. With an emergency fund, your main investment remains intact and continues to compound year after year. Then there's the more uncomfortable but essential part: minimal and stable personal expenses. It's not about living a miserable life, but about living smart. Reducing fixed expenses on housing, transportation, food, and subscriptions turns that $300,000 into a nearly self-sufficient structure because every dollar you don't spend unnecessarily amplifies the fund's capacity to support your needs. Bogle insisted that financial independence isn't the result of high income, but of sensible habits. A moderate lifestyle makes the plan not only work, but also resilient to market fluctuations. This combination, total market index fund, prudent withdrawals, annual rebalancing, emergency fund, and optimized living, transforms $300,000 into a kind of slow-burning engine. It's not fast, it's not noisy, and it doesn't impress from the outside. But it's stable, predictable, and mathematically reliable. It works because it eliminates the areas where humans typically fail, letting only structure and time do their job. And ultimately, this plan is the exact embodiment of Bogle's thinking, radical simplicity that triumphs over unnecessary complexity. By following it, you're not betting on anything extraordinary. You're letting the extraordinary be the long-term regularity of the market. That's why this model works even with capital that many would consider insufficient, because it doesn't need magic to sustain itself. It's simply coherence. Jack Bogle's message was never about becoming rich. It was about becoming effective. He didn't preach secret techniques or privileged access. He preached something far more uncomfortable for most people: efficiency, patience, and discipline. And that's why his philosophy works even with numbers that many consider too small to matter. Because the truth is simple. $300,000 is not a magic number. It's just a sufficient number when paired with the right strategy. A strategy built on the same pillars Bogle defended for decades: bajas comisiones, low costs that protect your returns from silent erosion; alta disciplina, consistency that survives both boredom and fear; cero especulación, no guessing, no chasing, no hero trades; rendimientos del mercado, you take what the market gives, no more, but crucially, no less. Vida simple, a lifestyle aligned with what you truly value, not with what others expect. When you combine these 5 elements, something remarkable happens. You no longer depend on high income, lucky timing, or market genius. You depend on math, structure, and human behavior. 3 things much more predictable than luck. That's why Bogle's message was revolutionary. You don't need millions. You need a plan. And a plan based on these principles doesn't promise extravagance. It promises freedom. Not the flashy, cinematic kind, but the quiet, durable kind that lets you wake up every morning without fearing the next economic headline. Freedom built not on wealth itself, but on how you manage whatever wealth you already have. If you understand eso, entonces entiendes el corazón de la filosofía de Bogle. Financial independence isn't purchased with money. It's engineered with strategy. And if you want more content like this, real strategies, not hype, hit subscribe and tap like. Think of it as the lowest cost investment you'll make today, and one of the few guaranteed to pay off